Hello and welcome back to Wealthy for Real. In my prior video on the factors that go into determining your credit score, I discussed the importance of having a good payment history because that makes up 35% of your credit score. Because of this, there has been a long-standing myth that it's important to keep a balance on your credit cards so that you always have something to pay on monthly that can go towards maintaining a good payment history. In trying to keep up with this myth, many people are leaving a balance on their credit cards for years, only paying the minimum required amount each month. While there are some underlying benefits that can come with paying the minimum balance on your credit accounts, like preventing your accounts from automatically closing from inactivity or avoiding late fees from non-payment when you can't afford to pay the entire balance, rarely do we take into account the true cost of only paying the minimum balance on your credit cards or of any revolving accounts that you may have. Here are some reasons why you'll want to reconsider paying only the minimum amount on your credit accounts. While many people keep a balance on their credit cards in hopes of improving their credit score, doing this could actually have the opposite effect. While on-time payments make up the biggest percentage of your credit score, your credit utilization is not too far behind that, making up 30% of your credit score. Your credit utilization is determined by dividing your outstanding credit balances by the total credit limit that you have been granted. For instance, if you have a credit limit of $5,000 on a credit card and you have a balance of $1,000 on it, your credit utilization is 20%. It's a standard rule of thumb to keep your credit utilization ratio under 30% at all times to avoid your credit score becoming negatively affected. If your utilization is close to or over 30% and you're only paying the minimum allowed amount each month on your balance, you could be doing more harm than good by not paying down your balance as quickly as you can. If you have a goal of becoming debt-free, this may serve as another reason for you to reconsider only making minimum payments on your credit account balances. Paying only the minimum amount possible on credit balances only prolongs the amount of time that it'll take for you to pay off any debt that you have and truly become debt-free. As a general rule of thumb, it's always a good idea to pay off any interest-bearing debts as quickly as you can, because the longer that debt stands, the more you pay in interest over time. Let's say you have a credit card with a $5,000 balance and an 18% APR, or interest rate. If this particular credit card requires a minimum payment of at least 3% of your total balance each month, it will take you 16 and a half years to completely pay off that initial $5,000 balance. And by the end of that time span, you would have ended up paying $4,698.44 in interest, bringing your total payments up to $9,698.44. Almost double what you initially charged on that card in the first place. There are many online calculators that can lay out exactly how much money and time you are losing by paying only the minimum amount on your credit card balances, like the credit card minimum payment calculator from bankrate.com that was used for this demonstration. You can find a link to this calculator in the description below. While this video is focused primarily on the negative effects of paying the minimum amounts on your revolving credit accounts, like credit cards and credit lines, this particular downfall also applies to your installment accounts, like auto loans and mortgages as well. Why do you think car salesmen often try to entice you by telling you that they can lower your monthly payment in exchange for a longer term on the loan? The truth is, while lower monthly payments may seem like you're getting a sweet deal, the dealership is actually winning in that transaction because the longer it takes you to pay off that loan, the more money you end up paying them in interest when it's all said and done. The same thing goes for a mortgage. Most people decide to get a 30-year mortgage when they purchase a home due to the lower monthly payments that they're obligated to pay. But a 15-year mortgage, with all other variables of the deal staying the same, results in paying less for the house over the term of the mortgage because the shorter payment period saves you a boatload of money in interest. After taking in all of this information, you may be listening and saying, well, if I can't keep a balance and pay the minimum amount due in order to build good credit payment history, What am I supposed to do? I'm glad you asked. One good way of getting the benefits of a positive payment history on your revolving credit accounts is to only use your credit card for small purchases that you can afford to pay off within the next month. This way, you won't ever have an outstanding balance on your card, and in turn, you won't be getting charged interest at all. Remember, outside of absolute emergencies, credit cards should not be used to purchase anything you cannot afford. If you can't pay off whatever you charge on your credit card within the next 30 days, you can't afford it. Now, I know. Some of you weren't told all of this information when you first started using credit, and y'all are probably thinking, yeah, okay, all that sounds good, but for me the damage has already been done, and I'm trying to pay down my credit card balances, but I can't afford to pay anything more than the minimum right now. I completely understand how that feels, and my advice to you is to find out where all your money is coming from each month and where all of your money is going each month, and rearranging your budget to cut out the things that you're spending on that isn't benefiting you so that you can free up more money to pay your debts down faster. I go into more detail on exactly how to do this on my previous video on the number 1 rule of personal finance. A little trick I would also suggest to help pay down your outstanding balances quicker when you feel like there's not too much leeway you can make in your budget is to start making bi-weekly payments of half the total amount twice a month instead of the full payment amount once a month. For example, if you're currently making monthly payments of $300 a month to pay down debt, try instead to make a payment of $150 every 2 weeks. While doing this will make you feel like you're still paying $300 a month to pay off the debt, you actually end up making an entire extra month's payment each year when you structure your payments this way. Here's how. When you go the traditional route of making one full payment each month, you end up making 12 full payments a year since there are 12 months in a year. When you split up the amount and pay half every 2 weeks, you end up making 26 half payments each year, since there are 52 weeks in a year. The 26 half payments equates to you actually making 13 monthly payments in the full year instead of the 12 monthly payments that you make when you pay down the debt in the traditional way. Making that extra monthly payment every year can knock off many years and tons of interest from your total payment amount without you even noticing the difference. With all that said, if you made it this far through the video, thank you for watching. I'd also love to hear from you. Have you been making minimum payments on your debt each month, not realizing how it can negatively affect you? Did you learn anything new that you plan to implement going forward? If so, let me know in the comments below. Also, if you've been finding any value in these videos, give that like button a tap and subscribe to the channel to continue to learn small steps you can make today to take control of your finances and move forward toward the goal of becoming wealthy for real.